Welcome to the Legacy Leaders Podcast. Are you doing the best for your client to help them create their legacy? Are you creating a plan that goes far beyond finances to help people ensure that it becomes the driving force behind all decisions? On this podcast, hosts Katie Beth Hand and Stan Miller will help you with growing your practice and your clients' peace of mind. Together, they bring the best and brightest minds to share with you how to help your clients develop their best legacy. And now, here are your hosts, Katie Beth and Stan.
Welcome back to the Legacy Leaders Podcast with your hosts, Stan Miller and Katie Beth Hand. Our guest today is entrepreneur and Percent CEO, Nelson Chu. Nelson, thank you so much for joining us today.
Thanks so much for having me. Excited to be here.
Absolutely. So before we dive in, I would love it if you would take just a few minutes and tell our listeners a little bit about Percent and the services that business provides. And then as you do that, tell us a little bit about your background and really what got this started.
Sure, absolutely. So Percent is a alternative investment marketplace, and you've probably heard of a bunch of others that are out there in the street, but our focus is specifically on private credit. And I'd like to think that we were doing private credit before it was cool, because we were founded the company in 2018, and now all anyone can talk about is private credit. But there's a good reason for that. I think private credit, it provides almost like non-correlated returns to public markets. And so to define what private credit actually is, think of it as like non-bank lending, right? So you had the global financial crisis, where all the banks used to do all of these loans to small businesses and consumers, and they stopped doing that because of regulatory reasons. So the need from businesses and consumers was still there, in which case non-bank lenders came in to fill in the gap. Non-bank lenders don't have a balance sheet. They don't have a deposit base. They have to raise money from somewhere else, and they tap into the private credit markets for that. So think of a firm and SoFi and all these other lenders that you may recognize. Those are all private credit lenders before they turn public, and that was what we support, right? So our platform allows for investors to actually get access to these up-and-coming lenders, fintech lenders, regular lenders, and get exposure to a diversified pool of loans ranging from small business loans to consumer loans in a very, very easy-to-use experience that allows them to diversify their portfolio in a way that they normally probably wouldn't think about doing before without us being around. We founded the company in 2018. Like I said, my background is in traditional finance. I think you almost have to have a little bit of that to do what we do here today. But I only spent about 2.5 years there. The rest of my experience was definitely more in the technology side of things, founding a consulting company that helped other founders build their companies from the ground up. And so my expertise is definitely more in product and tech. But fortunately, we have a whole other side of the house and the whole broader team that has debt capital markets experience that brings all of that to bear here and Percent as a company.
That is great. So tell us a little bit about your personal background and what got you interested in this type of industry, just in general. What made you interested in finance? What made you decide to start Percent?
Yeah, so I'd like to think that I was actually always destined to be an entrepreneur at an early age, if only for the fact that I was very rambunctious as a child and I didn't listen to anything my parents said. So I was always very hard-headed, if you want, had my own opinions, but I was surrounded by people who did start companies themselves, right? So my father was an entrepreneur in his own right. He co-founded a software company focused on airline crew optimization, which is a very specific niche. But back in the day when you were flying on, I don't know, like Continental or like American Eagle or Alaska Airlines, they used to schedule their crew, their flight attendants and their pilots using index cards and whiteboards every single month. So that was a little bit horrifying. But the company that my father helped co-found was basically bringing all that using software together to actually algorithmically schedule crew and flight attendants and actually maybe prioritize preferences around, I need to be in this city for my kid's birthday, or I need to be in that town for whatever reason. And so all those things came to bear. And so he was always actually very encouraging on me to try things, right? So I actually did everything outside of academics when I was younger, pretty much. Whether it was like teaching myself Photoshop, I became like a little mini filmmaker, I like modified the heck out of my car, all these things that my mom was horrified about, I did because it was way more fun than doing school. When you graduate high school, you got to go to college. So I went to college for about, graduated 3 years because I wanted to work. And so came out with a double major and a minor in econ, poli-sci, and philosophy, of which maybe only philosophy is useful today in the grand scheme of things. But after that, graduated in 2009. Interesting time to be joining finance, but I did have to get a job. And so I saw firsthand the remnants of the global financial crisis, if you will. But like I said, lasted 2.5 years in traditional finance before I said I'm done with it. So the consulting company that I had founded actually served a lot of fintech companies, right? Like I actually had a finance background. They appreciated that. And so I saw a good view of the fintech landscape back in 2017, 2018. syndicate team. And so we figured for the right idea, for the right time, we can use a team that we have here that knows how to build stuff, use our network of investors to be able to fund the company. We would just jump ship and do something ourselves, right? And that's when we came up with the idea for Percent. So Percent is a pretty unique opportunity and value prop back in the day, at least, because all these other platforms that are out there for alternative investments had super long durations. As an investor, I tend to not want to lock my stuff up for 4 to 5 years. And that's what it required, right? It required pretty high minimums for a company that I had never met before. So they wanted 25, 30 grand from the get-go, which is just asking a lot for me who has no idea who you are. And then ultimately the yields were the same, right? 9 to 16%. So our theory was that if we came up with a shorter duration product, a lower minimum product, and the same yield as everybody else, we'd probably get some interest here, right? And so that's really what started the genesis of this. We had a 1 month product, a $500 minimum, and a 9 to 16% investment, and we just got a lot of interest out of that. And we've evolved the company from there to be much more software oriented, to be able to bring more volume into the market by helping other underwriters like us bring deals to market, tapping into the investor base that we have today.
That is very interesting. Yes, I can relate. I was a political science sociology double major that graduated in 2008. So a really great year to graduate with that political science
Absolutely.
degree. The job market was great. Interesting time. But it's interesting for kind of our generation. It really forced us to get creative, right? Because nobody was standing there waiting with the job you'd been told you were going to have. You had to go and find your own way in the world. So I love that kind of pushed you into creating this company. I have a lot of great questions, Dan. I know that you do too. Talk to us when it comes to this company. Talk to us a little bit about the pros and cons in investing in the private credit.
Yeah, private credit is, look, I'll be the first to say, even though I already have a very biased opinion, it should not make up your entire portfolio, right? That is like, let's bar none for sure. And there's obviously pros and cons to the asset class itself. The pro is that generally in private credit, unless you're investing in like a single company's debt, it's usually a pool of loans, right? Like a firm has, I don't know, hundreds of thousands of loans as a buy now, pay later lender. And so you'd get exposure to all of them. And so if one of them defaults, you're not really at risk. It's actually a portfolio level look. And at the same time, the actual inherent performance is not really tied to the stock market either, right? Like obviously, if there's a recession, then there's broader macro concerns. But if the stock market goes up and down, it doesn't matter. The portfolio loans probably is still going to perform. So uncorrelated, predictable returns is a great position to be in. The yields themselves are also going to be higher than what you can get in a high yield savings account. These days are pretty good, but it's way higher than that, right? So our weighted average returns on the portfolio today is about 18%, right? So that is like definitely higher for sure, but also net of charge-offs, write-offs, defaults, workout, whatever it may be, our trailing 12-month performance is still 14.5%, right? So if you invested in every single deal, you would have made 14.5% in the most diversified way possible, which is pretty good in this environment, right? So that's all good. The downside to that is that I will be the first to admit anything that's yielding 14% comes with risk, right? So be aware of that when you go into it. In the same way that if you invest in a single company's loan, that's the highest risk possible because you're banking on that company knowing exactly what it's doing. It's going to work out. You should diversify your exposure here. And we provide that vehicle as well, right? So we have what's called like a blended note. You can almost think of it as like a diversified basket of loans to or financing to these various different companies where you would have 20 different exposure to various different lenders, of which they may each have 100 to 200 loans in that portfolio. So think about how diversified that is. And at that point, that's a much more risk-averse product than just investing even in one of these borrowers who may have a couple hundred loans in that portfolio. So we try and find ways to help investors mitigate their risk, but it definitely comes with risk at that yield. And I'm not going to be sitting here saying that it comes with no risk at all because it comes with the territory of being private, having that level of yield. It's just part and parcel for what the space that we play in.
Absolutely. Okay, I've taken up all of the questions so far. Stan, what questions do you have for Nelson?
Oh, okay. I got tons of questions. So my first question is, I know you, like all of us, probably hang on every word that J. Powell says. In last November, there was a lot of optimism that maybe we're going to start cutting rates here pretty soon, but then that narrative changed. And then we started hearing about, well, maybe rates are going to be higher for longer. I'm not sure where we are. We're recording this in early May, and we've had a pretty good run in the market here in the last few days. But I'm curious, what's the interplay between the perception or the reality of the trajectory of interest rates on the private credit space. Is the higher for longer narrative good for you, or is it not good for you? What happens to the private credit business if the Fed meets in June or September, whenever, and they tell us for sure we're really cutting rates? What's the impact? What's the interplay?
Yeah, for sure. I'll give you the percent company line, and then I just have a ton of opinions about the Fed. So I'll start with that at the very least, which was it was just very baffling to me at the end of last year that they said they were going to cut this much in 2024, right? It just made no sense in the sense that if I'd like to think that they look beyond just the numbers and CPI, I think they call it like supermarkets for prices. That's just insane that in this day and age, that's how we're getting information. But the reality is, it is expensive right now. Like inflation is running all over the place. And the things that are you need on a day-to-day basis are actually way more expensive than the things that you don't need all the time have come down in price. So I think the average consumer is getting hit by that for sure, right? Like you're seeing that. And so the expectation that rates were going to get cut so early on with that much in 2024 just was very baffling to me. If I was a betting man, don't hold me to that. It's not a bet. But I would say there's probably 1 or 2 cuts happening, but towards the tail end of the year, right? If we're lucky. But it's going to depend on a lot of the numbers looking in favor of what they're looking for, right? So that's at most, I think, is what's going to happen. Now, on the private credit side, it's been interesting because we've been around for 6 years, right? So we've had a low rate environment, we've had a COVID rate environment, we've had an influx of money environment, we've had a high rate environment, we had a plateauing rate environment. So you see the real-time reaction from even investors around what they expect in this space. And what we've learned essentially is that retail investors specifically, so we're talking like accredited investors who liquid net worth of $1 million plus or W-2 income of $200,000, they want a 10% spread above the risk-free rate, right? So average yield of, I would say, 15 to 18% is a sweet spot that they're looking for from their private credit portfolio. For a family office, we've seen that be 8 to 10%, right? So they want probably like 13 to 15, maybe a little bit less than that, right? Somewhere around there. And then credit funds, investment advisors, institutional investors, they want 6 to 8% above the risk-free rate. So there's a sliding scale of this is my premium that I'm attaching on top of private credit. But naturally, the lower the rate oftentimes comes with a safer asset. So the larger you are, the more inclined you are towards chasing after assets and products that are, I would say, on the safer end of the risk spectrum, just because the amount of money that you manage. So that's sort of, we've seen that correlation pretty clearly at this point. In a high rate environment, in a low rate environment, as percent as a company, doesn't matter to us, right? There's always, the interesting part about fixed income is that there's always a price where someone's going to take it. And we always help try and find what that price is going to be. And the tooling that we've created gives the clients that we have a lot of optionality around, do I want to take more money, but it's more expensive, or less money if it's less expensive? That optionality is what we enable, and investors can even dictate where they'd like to see this get priced at. So this constant, like almost like free market dynamic we've created here makes for a very interesting proposition. And we'd like to think that no matter what happens to the rates, stay higher for longer, come down very quickly, go up very quickly. Doesn't matter. That sliding scale is going to come out on a regular basis. And that's why we've seen it play out for the last 6 years.
Okay. Well, interesting answer. Your answer surprised me because I was expecting something different, but that's good to know. So I'm curious, about percent. And as you do point out, there are now a lot of players out there in the private credit space. A lot of them are available, publicly traded BDCs, for example. So what is it? What is it that you guys do at percent that you would say differentiates what you do from, let's say, BlackRock, Apollo, Blue Owl, any of those guys?
Sure, absolutely. And look, we love those guys, right? Like, I think they've put private credit on the map. We've gotten tailwinds from just all the things that they're doing around publicity and press and things like that. So keep doing what you're doing. I'm happy with that. The reality is they play, because of the size that they play in a segment that is so much later stage than we are, right? So the yields are going to be lower. They're going to be able to return capital more slowly. These are longer duration investments. That's just naturally the way it works, right? So they play in like the large cap, maybe even middle market, but generally large cap space. We play in what's firmly lower middle market. So what's been interesting is because we've been getting a lot of feedback from our family office investors, our investment advisor investors, and they're basically saying, look, I'm invested in BCred. I'm invested in Apollo. Like, I have that, right? I don't look to you for that. That's fine. They'll do what they're doing. I want my firm lower middle market 15 to 18% returns on your side. And that's what I look to you for. Don't go lower than that because then it's not interesting for me. I'm just going to go over there. So there is a world where both of these should exist and do exist, and we survive very harmoniously with one another. And we don't view them as competitors. I think we view them as groups that actually help augment our story because there is yield to be had at every end of the spectrum here, from a risk and from a size and from a duration perspective.
Interesting. I see exactly where you're coming from this. So tell me and you touched on it, but expand on this a bit. What's the ideal client of yours look like? Or maybe beyond that, what's a typical client of yours look like? What's their net worth? How much will they invest with you? I've got to believe that there's some threshold of investment that they have to make in order to make it worth just the administrative time and hassle, right?
So the beauty of being a tech company is that the administration side for a person who invests $1,000 with us and a person who invests like multi-millions with us is the same. Doesn't make a huge difference at all, which is nice, right? Actually, it helps the investor because, like I said in the beginning, we came out with a $500 minimum. Now, as an accredited investor who makes 200,000 plus a year, has a million net worth, I'd like to think they would invest more than $500. But what the $500 allows them to do is almost try before they buy, right? So they can actually just say, let me put in $500. If it's a scam, if it's a fraud, it never comes back. I'm not sweating this. But if it comes back in a month or two with interest and it fully repays back principal, maybe I'll put a little bit more, right? So what's been interesting is we're seeing investors themselves continue to invest and add to their portfolio over multiple quarters until they settle around a steady state. And for us, about 5 quarters later, they've given us all the money they could possibly ever want to give us because that's their private credit allocation, essentially. And that's for retail investors, right? So retail accredited investors make up the majority of the number of investors that are on the platform. But I would say they are making up a significantly smaller portion relative to the number of them of the assets that are on the platform. So institutional investors like family offices, investment advisors, credit funds, they put way more money to work, right? And their try before they buy is like a couple 100,000. Basically. So it's a different approach to how they do this, but it's just based on quantum of capital, proportion of capital that they have, things like that. But we love them all equally, right? I think because you mentioned clients from the investor side, we have clients as well from the borrower side too, right? So the retail accredited investors are fantastic at helping close deals for up and coming borrowers. They're going to be people that need companies that need 250,000, 500,000, right? A couple of those accredited investors will help close that deal. An institutional investor won't even look at that. They're like, you have no track record. Like, I'm not going to give this to you, right? You've been around for a year and you've done $1 million worth of loans. Like, this doesn't make any sense for me. But as the retail investors prop up these borrowers, they get bigger, they scale, they end up reaching institutional scale for us. And then these institutional investors come in, they grow them even further. And then a lot of them leave our platform, right? Because they get so large that we're like, look, you shouldn't want us anymore because I don't think you want several hundred investors owning your debt. I think you should find an institutional provider and we'll help you with that, right? And the holy grail is to get to from us to like, I don't know, at some point in Apollo, and then to dump Apollo and go to a bank. Like that would be the ideal outcome here because the bank always has the cheapest cost of capital. And we've seen that story play out multiple times and we're happy, right? That means our clients have done well and we help them do well as a result.
So what percentage as an individual private investor, what percentage do you think, and give me a range, not a hard number, but a range, what percentage should a private investor, an individual, commit to this segment of the market?
So from a compliance standpoint,
that
this is not investment advice by any stretch of the imagination, or my head of compliance is going to have a field day with me. But this is more just, I think, what we've seen, at least.
Okay.
Historically, around 10 to 15% of their portfolio is going to be in something like this, right? I would say that's probably even like a general alts portfolio as well. Like this, so it could be not just private credit. It could be some real estate investments. It could be some art. It could be some collectibles, whatever they want, whatever piques their interest, right? But alts in general is becoming definitely for sure a bigger part of people's portfolios. And we are seeing that grow. And we are seeing that private credit is taking up a bigger and bigger share of that. What's been interesting is that obviously, like we talked about, there's a lot of different platforms that are out there that offer, startup equity. They offer real estate. They offer private credit like we do. There's about 25% of our investor base that don't invest anywhere else at all. So like they just like private credit. So I'm fine with that. We're known for one thing and one thing only on the street. And I think that's helped us in that instance. So that's fantastic, right? I think we're a great option for people. And it's clearly showing up in the fact that they just look to us for their alts portfolio.
Yeah, so clearly there has to be a skill set in looking at a borrower and having a sense about what the likelihood is that they're going to default and then being able to continue to manage and stay in touch with that relationship so that you know ahead of time. And I guess maybe at some point have to work with them to do workouts. But you do have defaults, right? It's part of the reality of being in the space, right?
It's the reality of being in private markets, that's for sure. Yeah. And we have two types of underwriters or sponsors of a deal, right? Sometimes historically we've sponsored, we did every deal ourselves for the first 4 years of the company's life before we built out enough technology to actually open it up to other people, right? And at that point, we could say, okay, another credit fund can come in who's a sponsor. They can bring their company or their client on or their portfolio on, and then they can syndicate out a portion. And so they're the sponsor now, right? So the sponsor is responsible for a workout generally because they're the ones, their name on there, right? But either way, we have had defaults over time. I would say if we didn't have defaults, then we did something also wrong because we didn't actually understand how people were trying to take advantage of us in some respects as well. So you're gonna have to toe the line somewhere. What matters is what you learn from it, right? And what's been interesting is the defaults early on in the company's life, like in 2020, for example, that was like 4 years ago, those had very little recovery, right? And then now the most recent defaults, most of them have had full recoveries because the changes we've made to the structure, the changes we made to the way we operate from a process standpoint, and how we monitor portfolios has changed dramatically to the point where we can get in front of it or we know what's coming and how to handle it, which has been fantastic, right? Now, the beauty of being a tech company is that all the things that you mentioned in the old world is, let me call this person, I hope they send me a file, and then let me just see how it is, and then we'll see if it's performing as we expect. With technology, with the platform that we've built, we've been able to actually make it that much more efficient, right? So we do monitor the portfolio and the performance of their loans on a weekly and monthly basis, and we standardize it all, right? Investors have the benefit of being able to look at deal structures that normally in private markets look very different. You can compare them side by side with one another. This one has this default rate for the last 12 months. This one has this loss coverage. This is this level of advance rates. Like all these things are things that are apples to apples. Any single two deals that you look at on the platform, all 630 that we've done, right? So that gives investors a lot of understanding of how they should interpret why this one is yielding 17 and that one's yielding 12, right? Which is great. So standardization there helps. The monitoring also helps, right? So every single week we publish these reports. If this line dips below that line, someone's getting a conversation. Investors also know that someone's getting a conversation. So all those things are things that they can get in front of it to be able to understand whether this risk is worth it for them. And we have a history of this, right? So an investor is looking at a borrower who's been around the platform for a year or 2 years. They can look at every report we've ever published for the last 2 years and see if that performance is what they like before making a decision about coming into the next investment. It's as much transparency as we could possibly give in a private market that normally doesn't have it. Do I wish there was more? Absolutely. Are we trying to push for more? 100%. But it's going to be a process to get there, and we're not there yet. But we're making incremental strides every time, and it's showing up in our default rates. It's showing up in our returns that are all moving in the right direction.
Yeah. Well, that sounds good. So let me shift gears with you in the little bit of time we have left. I'm looking at all the other things, your non-business life or your non-credit life, and I'm trying to figure out what the theme is and all the different things that you're involved in. And I think there is a theme. I just don't know what it is. Can you shed some light on that?
Yeah, absolutely. So given that I'm in the startup ecosystem, obviously I'm an angel investor. I've invested in a bunch of companies. Some of them were my clients when I was on the consulting side, right? Some of them did really well. That's more of I would call that like a give back to the ecosystem type thing, because I think I've done okay, not phenomenally, but well enough to be able to make angel investments. And I get excited when I see founders who are just so passionate about something that let's see what we can do, right? And if I can help them along the way, every check comes with advice if they want it, at the very least. Some people don't want it. It's fine. And they do perfectly fine without it. So they don't even need me anyway. But that's just a fun thing to do, right? I'd like to say that I had a more diversified exposure across multiple sectors. I tend to invest in fintech only because like I can actually vet it and diligence it properly. So a little bit boring, but it's okay. On the personal front, on outside of angel investing, I've grown to build up an art collection, I would say, over the years, which I don't think you might have seen on my LinkedIn or anything like that. But that was a COVID hobby. So that was, I think, looking at my walls every day for 24 hours a day for several months. I was like, I got to fix this. And it's become a very, very, I think, fun passion of mine that I think I bought like 30, 40 pieces in the last like 3 years, give or take, something like that. So it's been fantastic. I think the apartment looks more lively. You can move things around and it like changes the vibe. It's very cool, right? And I think my art in general supports Asian American contemporary artists, which obviously hits close to home for me. But I've had the chance and the fortune to meet them in person in New York because they're obviously in Brooklyn and Manhattan and whatnot. And just hearing their story makes me love these pieces even more. So that's been such a great addition to my life, at least just from a cultural enrichment standpoint. And I've been on the boards of a bunch of nonprofits over the years, usually related to underprivileged kids either in New York or just all around the world. I've been the most involved recently with one called Yamba Malawi. And so for those who don't know, Malawi is one of the poorest countries by GDP per capita in the world. And this organization has been fantastic, right? So like they actually have done a ton of work to basically help the parents to ultimately help the kids. So Malawi itself used to be subsisting off of really terrible farming of crops like tobacco and cotton and things like that. Not good, right? So they've been actually shifting these parents towards doing honey and soy, things that are like in demand right now. And that actually pays dividends if you can buy it in bulk and you can sell it in bulk, things like that. And that ends up trickling towards the kids getting an education they weren't able to get before. So fantastic initiative, been able to support that, very fortunate to support that over the last few years and hoping to do more with them and others in the future as well. As just, again, a way to give back because I do feel very lucky in how I've been able to get to where I am. And I wouldn't be here today without, I think, the good fortune that I've been able to stumble into in some way, shape, or form.
Yeah,
Cool.
Yellow
So,
Malawi is a great organization. And you've also supported, I think it's Alicia Keys' initiative, Keep a Child Alive. Are you a runner? Do you support it in that way? Or how do you support it? What drew you to that organization in particular?
Yeah, so I was brought into that organization through a friend who knew the executive director at the time, and the executive director left to go to Yamba Malawi. So I've been following him technically. But yeah, no, so Keep a Child Alive was fantastic. I was involved more on the host committee side for the gala they did every year. And let me just say that was some of my favorite galas because essentially Alicia brought all her friends who were all musicians and just did like a massive concert every single year,
Yeah.
which was fantastic. And she is a phenomenal singer. It's amazing to watch her live. I believe she was pregnant all the years that I saw her at the gala because she had multiple kids and she was still rocking on stage as if she was totally fine. So it was amazing.
Very cool. And both great initiatives. And then tell us about the Bubble Foundation as well that you support.
Yeah, so they're no longer around. I think the founder actually ended up having other priorities. She's a phenomenal VC. She's actually the founder of Anthemis. But Bubble was almost like my next thing after Keep a Child Alive because I was trying to find other opportunities and things like that. And it, I think, hit close to home because all the ones that I had supported before were all international organizations. And there is such a problem of food scarcity in New York City. There's such a problem of the fact that in the inner city, the pharmacy is next to a fast food stand, which is next to apartments, right? Like they're like literally just that. And so people just go step by step down the block, and it's a horrible vicious cycle they can't get out of. They have never gone to the grocery store. They've never bought like raw Whole Foods, right? And so the ability for Bubble to basically teach the kids at school how to actually cook, and cook is, these are like elementary school kids, but they are actually understanding like how to make these things that taste good. These kids like broccoli and kale. And I was like, I don't eat kale. And so it was just interesting that they were able to teach them that, and they brought it home. And the parents realized that it was actually sometimes cheaper to buy groceries rather than go to McDonald's or go to Popeyes or anything like that, which is fantastic, right? I actually did do a teaching at a school, which was very cool. And I really enjoyed that. So I wish that organization was still around because it does hit so close to home being in New York City. I think the founder has done fantastic things with Anthemis and all the things that she wants to do. So it's been great to watch her as well. She's risen to amazing heights, even though she was already fantastic and amazing when I met her.
That's fantastic. Great organizations. And I love that you're incorporating your passion for not just percent and building your own company, but for helping the world at large. And so I think that's wonderful. For everybody who is listening, this has been the Legacy Leaders Podcast with your hosts, Stan Miller and Katie Beth Hand. And our guest today was Nelson Chu. For more information on Percent, Nelson's company we talked about today, you can visit www.percent.com. And you can also find Nelson on LinkedIn. We will link both of those for you in our bio so that you can get connected. Nelson, thank you again so much for jumping on with us today. We really enjoyed the interview.
Thank you. It's a pleasure speaking with you both.
You've been listening to the Legacy Leaders Podcast with Katie Beth Hand and Stan Miller. For more information on them and the show, please visit pinnaclelegacylaw.com. If you like what you've learned today, do share the program with your friends and subscribe wherever podcasts are found.